Indian Accounting Standard. IND AS 23 Borrowing Costs. 1. Introduction. Every business needs money to grow. Companies take loans to build factories, buy equipment, or expand operations. However, when a company borrows money, it also has to pay interest and other costs. These costs are called borrowing costs. IND AS 23 explains how companies should record borrowing costs in their financial statements. Some borrowing costs are capitalized, added to the cost of an asset, while others are expensed, charged to the profit and loss account. 2. What are borrowing costs? Borrowing costs include all expenses related to borrowing money. These can be 1. Interest expenses, interest paid on loans, bonds, overdrafts, and other borrowings. 2. Finance charges on leases, the cost of borrowing under lease agreements, e.g., when a company rents machinery on credit. 3. Exchange differences on foreign loans. If a company takes a loan in a foreign currency, the exchange rate changes can affect the cost of borrowing. If these changes are linked to interest costs, they are considered borrowing costs. 3. Scope of IND AS 23. IND AS 23 applies to all companies that borrow money. It covers borrowing costs from banks, financial institutions, or other lenders. Specific borrowings. When a loan is taken for a particular project, e.g., a factory. General borrowings. When loans are used for multiple business activities. 4. How should borrowing costs be treated in accounting? A. Capitalization of borrowing costs. Capitalization means adding borrowing costs to the cost of an asset instead of treating them as an expense. However, this is allowed only for qualifying assets. What is a qualifying asset? A qualifying asset is an asset that takes a long time to be ready for use or sale. Examples include buildings, factories, offices, shopping malls, etc. Manufacturing plants, large-scale machines used in production. Infrastructure projects, bridges, highways, airports, railways. Intangible assets, patents, software, or research projects that take time to develop. When to start and stop capitalizing borrowing costs. Capitalization starts when the company has started spending money on the asset. Borrowing costs begin to be incurred. Construction or development work on the asset is actively in progress. Capitalization stops when the asset is ready for use or sale. If the construction is delayed for a long time, capitalization must also stop during that period. B. Borrowing costs that must be expensed. If the borrowing costs do not relate to a qualifying asset, they must be recorded as an expense in the profit and loss account. Example: a company takes a loan to purchase raw materials. Since raw materials do not take a long time to be ready for use, the interest on the loan is not capitalized. Instead, it is recorded as an expense in the profit and loss account. 5. How to calculate borrowing costs for capitalization. Borrowing costs can be classified into two types. A. Specific borrowing, loan for a particular asset. If a company takes a loan specifically for an asset, only the interest on that loan is capitalized. Example: XYZ Limited takes a 10 crore loan at 8% interest to construct a factory. The annual interest equals 10 crore times 8% equals 80 lakh. This 80 lakh per year is added to the factory's cost until the construction is complete. B. General borrowing, loan used for multiple purposes. If borrowings are used for multiple projects, not a single asset, companies use a weighted average borrowing rate to determine the capitalized cost. Example: a company has multiple loans at different interest rates. Loan 150 crore at 9% interest. Loan 230 crore at 7% interest. Total borrowings equals 80 crore. Weighted average interest rate equals 50 by 9% plus 30 by 7%. 80 equals 8.25%. If the company spends 10 crore on a qualifying asset, the borrowing cost capitalized equals 10 crore times 8.25% equals 82.5 lakh. 6. Disclosure requirements under IND AS 23. Companies must disclose the following information in their financial statements. 1. The amount of borrowing costs capitalized during the year. 2. The capitalization rate used for general borrowings. 3. The accounting policy for capitalizing borrowing costs. These disclosures help maintain transparency in financial reporting. 8. Conclusion. IND AS 23 ensures that companies correctly account for borrowing costs in their financial statements. The key principles are: borrowing costs related to long-term assets, like buildings, must be capitalized. Borrowing costs related to short-term expenses, like raw materials, must be expensed. Proper disclosure must be made to ensure financial transparency.